Distressed debt has reached $250 billion, according to Bloomberg. Lebanon, Sri Lanka, Russia, Suriname, and Zambia are already in default. Of some 73 highly indebted nations tracked by the International Monetary Fund, IMF, roughly 40 are in the danger zone. The COVID-19 shutdown worldwide had already increased countries' debt burdens, and with the global economy now suffering from inflation fever, food shortages, supply chain bottlenecks, and Russia's chokehold on energy supplies, low-income countries have failed to recover. Bad decision-making by these governments' leaders, too, has played a role. In panic mode, securities markets exaggerate the risks, exponentially increasing the costs to end a debt crisis. Efforts now to initiate immediate responses and reach agreement on medium and long-term responses could ease investors' angst. With the wake-up call sounded repeatedly by the World Bank and the IMF, the United States must start working on approaches to contain and reduce the debt crisis. Welcome to Savvy Economists. Today on this video we would be discussing the worsening debt crisis and how the dollar is playing a major role in causing this surge. We would also be listening to Gade, who spoke with David Lin, anchor and producer at Kitco News. Before we get into the video, ensure to hit the like button, subscribe, and turn notifications on.
If you were to look at the percentage of weeks as a percentage of the year, the amount of times that yields have risen, right? Meaning that treasuries have lost money, yields have risen, that which the US government uses basically to fund its deficits. You've never had a time in history where 68% of the weeks in any single year, yields rose. Now, why is that consequential? Because if yields keep rising like this with $30 trillion of debt, never mind the unfunded liabilities, that means that suddenly, as that $30 trillion of debt needs to be rolled over, now it's going to have to be on a higher interest expense. This is a real big issue because the US government can't pay that off. And if interest expense ends up being as large as your taxpayer base, and you're unequivocally in, real default risk territory, or at least maybe a Japan-like scenario where you have just a terrible environment for many years to come. The bigger issue, though, I think, is that you have a real strain on the international side. Right? We know that a lot of sovereign international entities borrow in dollars for debt. And as they scramble for dollars, as the dollar itself keeps on rallying and rising and their currencies depreciate, there becomes a real funding strain for these economies that don't have the luxury of being the reserve currency and that cannot rely on modern monetary theory to pay off those liabilities. So we are in this really nasty situation. I keep going back to this point that you've never had a period where your starting point of leverage is so high, you've got higher interest expense, collapsing tax receipts because capital gains are evaporating, and everyone just being apathetic to the idea that maybe things will be okay when it really may not be. Everything is based on the new debt, which includes mortgage rates, which includes all the other very big purchase for the economies. The new debt is what sets the marginal rate for everybody else in terms of that which ultimately taxes are based off of, right? That's the real issue, right? So it's more than just the interest expense. It's about what does the higher interest expense mean on revenue also from the taxpayer perspective. So you end up getting to the same place of some kind of potential crisis. The issue for me is the dollar acting the way it is. I keep going back to this point. Most sovereign debt crises are preceded by currency volatility first. You look at the yen, you look at the euro, there is real strain going on outside the US. And I don't know, it seems really bizarre to me, the complacency when it comes to the stock market, because everything around the stock market is screaming and the stock market's not really listening. It's gone risk-off perspective. All the funds that you see behind me they're all predicated on the idea that treasuries act as the risk-off safe haven. But if you're in a year where treasuries are losing money week after week after week in such an unrelenting way, in a way that history would never suggest has ever happened, that becomes wildly difficult to rotate around equities and treasuries, trying to play defense with that which is supposed to be the safe haven asset, quote unquote, right? At least for now.
Gates research shows that treasury yields on a weekly basis have been rising 68.6% of the time in 2022, a level that is unprecedented. Rising yields could weaken a government's ability to fulfill its debt obligations. My hope is that this anomaly ends and that we're not headed for a sovereign debt crisis, said Gade. We want to be really careful about how despotism happens. Conditions create the monster. What I'm really referring to is how the Weimar Republic created conditions for Hitler's rise to power. Although Gates said that another Hitler-like despot is not necessarily going to arise, he stressed that conditions in the German Weimar Republic of the 1920s, with its high inflation and debt troubles, are analogous to the U.S.'s similar problems today. Judging from press reports, little has been said in public by either Powell or Treasury Secretary Janet Yellen about the high dollar's impact on poor countries' sovereign debt. In July, Powell used a Fed-sponsored conference on the dollar's global role to tout the currency's advantages and unrivaled status. His justifications for the Fed's inflation-cutting strategy are repeatedly domestic in focus. To use Powell's words, is this rational inattention? Yellen's focus at G20 meetings has been on an oil price cap, shoring up Ukraine's economy and pressuring China to both reveal more about its lending arrangements and restructure low-income countries' debt. Little has been said, too, by President Biden or other key administration staff about the defaults ahead. Elevating the situation to a top priority, with Powell and Yellen being more expansive in their remarks about the sovereign debt crisis, is a necessary and urgent step to begin managing the outcomes. They should also establish U.S. leadership, particularly in building support from the richest nations to use their collective leverage in negotiations with private creditors. First on the agenda should be the immediate suspension of interest payments for the time being to give countries breathing room, as some experts have proposed. A baseline assessment is urgently needed from the World Bank and the IMF, one that uses realistic projections of economic outlooks to better understand each country's likelihood for servicing debt. Their effort should include obtaining information from China about the size and terms of its lending, which accounts for 18% of credit owed by 68 countries. Debt restructuring must be pursued, but coordination is tougher given the diversity of creditors and their terms. The G20 Common Framework is a starting place for addressing insolvency and prolonged liquidity problems. Negotiations must start now regarding the volume, speed, and terms of new money. One roadmap for solutions is the one offered by the Center for Global Development. It advocates for clearer steps and detailed timelines while strengthening incentives for private creditors to rework loan terms. Better integrating IMF's financing programs, such as its lend into arrears, into the framework could address the recalcitrance of private and public creditors. The US dollar has been gaining strength relative to other major global currencies since the beginning of this year. So far, the US dollar index has grown more than 13% to hover around 109. The higher than expected interest rate hikes by the United States Federal Reserve is the major driver behind the strong dollar. To rein in the runaway inflation, the Fed has increased the benchmark interest rates 4 times since March, raising the rates radically by 225 basis points altogether. The growing gaps between the interest rates of the United States and other countries have triggered massive capital flows from the rest of the world to the U.S. The Ukraine crisis is another key factor behind the surging dollar. The worsening geopolitical instability has prompted international investors to seek shelter and boosted the demand for safe haven assets. Global capital has been fleeing Europe and emerging economies and flocking to dollar-denominated assets. The turbulent global financial market aggravated by the U.S. interest rate hikes and the Ukraine crisis has pushed the dollar to its highest level in 20 years. The strong dollar has exerted wide-ranging impacts on the global economy, which risks derailing the economic recovery of developing countries. Since 2021, developing countries in Asia have embarked on paths of recovery thanks to the rebound in external demand. As some countries have been actively approving new investment projects and some have rolled out development strategies to support infrastructure building, investment and consumption in developing Asia have also revived. However, as most Asian developing economies are export-oriented and heavily dependent on external demand, a strong dollar may have significant influences on these countries. It can drive up import prices, leading to heavier cost burdens on enterprises that rely on imports. Moreover, higher import costs may spell imported inflation, dampening domestic demand. In terms of exports, a strong dollar may give developing countries price advantages in exports, countering the negative effects it brings about. However, as the strong dollar is largely the outcome of the U.S. tightened monetary policy, it will inevitably be accompanied by weak U.S. market demand, which in turn will have a negative influence on the exports of developing countries. A strong dollar may disrupt the economic growth of developing countries through capital flows and financial markets. The global capital flows to dollar-denominated assets place huge pressures on the stock, bond, and foreign exchange markets of developing countries. In the first quarter of this year, foreign investors withdrew $31.9 billion from China's bond market and $6.8 billion from its stock market, the largest capital outflow on record. In India, about $28 billion has been pulled out from the country's stock market in the first half of the year, the largest among Asia's emerging economies. By mid-June, the Bombay Stock Exchange Sensitive Index or BSE Sensex had lost more than 15% compared with last October. However, emerging economies in Asia remain a favorite destination for global investors. Since mid-August, China's stock market has seen a net inflow of capital, and the BSE Sensex has gained its lost ground and rebounded to the level at the end of last year. A strong dollar puts bigger pressures on the sovereign debts of emerging economies, which, however, is not regarded as a major risk in Asian countries where residents have high saving rates and thus rely less on external debts compared with Latin American countries. In a report released by the ASEAN +3 Macroeconomic and Research Office in April, the realization of a sovereign debt crisis in ASEAN +3 economies, ASEAN countries and China, Japan and the Republic of Korea, is deemed merely a tail risk. And the three major global rating agencies have barely changed the sovereign debt ratings of Asian developing countries. However, the risk of a sovereign debt crisis remains serious for a few vulnerable economies, such as Sri Lanka. To alleviate the external pressure, some countries have increased interest rates and tightened monetary policies, which, on the downside, will hold back economic recovery. Higher interest rates dent people's willingness to seek loans, which will hamper the recovery of domestic consumption. Meanwhile, enterprises will face bigger risks of debt default and higher borrowing costs, thus having weaker capacities to invest. Governments will also bear greater burdens to pay debts, aggravating their fiscal vulnerabilities. All the above-mentioned factors will hinder the economic growth of developing countries. Debt crisis is gradually crippling the economy of many developing countries, and there are not so many solutions or policies set in place for its control. We would love to know if you have any suggestions in the comment section. Don't forget to hit the like button, subscribe and turn notifications on. Thanks for watching.